Hello and welcome to Business 360. I'm Archana Solanki and here are the headlines we're tracking this hour. Sensex gains over 500 points after last hour's surge. Nifty reclaims 18,000 mark. Mid-caps and bank stocks underperform. Rupee weakens against the dollar once again as it moves closer to the 82 mark. Government cuts the windfall tax on crude oil and the export tax on diesel and aviation fuel. Global crude oil prices continue to inch higher amid hopes of sustained demand recovery. 73% of global CEOs expect growth to decline over the next 12 months, the most pessimistic outlook in over a decade, according to a PwC survey. But 57% of Indian CEOs expect the country's economic growth to improve. The survey also shows China remains the second most attractive investment destination after the US. RBI floats a discussion paper proposing stricter rules on provisioning for loans. Banks must start providing for loans from the first sign of trouble and not after they have turned sour. The new rules may come into effect only after a couple of years, but PSU bank shares sulk in trade, fearing a hit to profits. China's population falls for the first time in 62 years. Experts believe China has entered an era of negative population growth. China's GDP growth slows to 3% in 2022, the slowest pace of growth in 47 years. All right, our top focus straight to the day's trading action. A last-hour surge had the last street end near the day's high. Nifty and Sensex gained 1% each, with Nifty heavyweights like Reliance, ICICI Bank and HDFC Twins saw a sharp move higher in the last-hour trade. Mid-caps relatively underperformed the benchmarks. Prashant Nair is here with the details. Prashant, over to you.
We've been complaining about the fact that the market on the Nifty at least has been stuck in a range for a while, and today perhaps there is a glimmer of hope. There was a break higher. The question is, will this last? But in any case, it was a good close for the index, and bulk of the gains came through in the last 45 odd minutes of trade. Banks underperformed. I mean, the bank index was only up about 0.25% or so. Pockets of gains largely came through from the energy pack. Reliance is, of course, the one to thank. FMCG, real estate and IT services are other sectors which did well. PSU banks, which was the big winner yesterday in a down market, actually underperformed and was down sharply in an up market today. So a bit of flip-flop coming in there. Large cap stocks, as I said, Reliance, of course, closed at the day's high. There was L&T, which was looking strong. HUL, out of the blue, came out and participated, propping up the FMCG space. Banks, I mean, actually HDFC Bank and HDFC primarily in the large cap space, and the IT services names are starting to come up a little bit. Like yesterday, HCL Tech and TCS stood out amongst large cap IT services. Advanced decline flipped between being positive and negative, and by close, I think it was largely even. But the losses coming through in names like Bank of India, the new age companies, Zomato, Nykaa, Paytm, all lost. Financials was a pocket of losses. Apart from the PSU bank space, Manappuram, PNB Housing, South Indian Bank were some of the names which saw cuts. There were gainers as well in names like IIFL, NHPC, Minda Corp was looking very strong, Specialty, Loda Developers and something like a Spencer's, which was up almost about 15% or so. With today's sort of move higher, the Nifty is reclaimed the very near-term 20-day moving average, which is watched very closely. US markets will open after a day of holiday yesterday, and I think all of that will be important when we come back to start trade once again tomorrow morning. Back to you.
All right, thank you, Prashant, for that. Moving on, in the currency market, the rupee weakened against the dollar for the second day in a row. It ended the day at 81.76 against the greenback. The weakness in the rupee was due to the weak Asian peers, dollar buying and dwindling upside momentum. In the oil market, crude prices remain mixed after China posted its weakest economic growth in nearly half a century. This despite the fact that its U-turn in COVID policies still supported hopes of a recovery in the country's fuel demand this year. In a relief to oil producers and refiners, the government has reduced the windfall gains tax on domestically produced crude oil, exports of aviation turbine fuel and diesel, while the tax on crude has been reduced from 2,100 to 1,900 rupees per ton. Tax on diesel exports has been cut from 6.5 rupees a litre to 5 rupees per litre, and similarly, windfall gains tax on exports of aviation turbine fuel has been slashed by a rupee as well. It's day 2 of the World Economic Forum at Davos, where world leaders policymakers and CEOs gather under one roof to discuss the challenges facing the global economy and the opportunities that can be capitalized on to navigate these choppy waters. This year's meeting is being held in the backdrop of the global aftershocks of Russia's invasion of Ukraine, rising inflation and prolonged restrictions in China and many pockets of the world. Staring at a recession, a global survey by PwC says 73% of global CEOs polled by it expect growth to decline over the next 12 months. This is the most pessimistic outlook in over a decade. However, 57% of Indian CEOs expect the country's economic growth to improve. The survey also shows China remains the second most attractive investment destination after the US.
What role will China play in the world in terms of the investments they're making? Let's remind ourselves they were playing a big global role with their Belt and Road Initiative, and as a result, you want to see that come to life as well. So that's going to be a positive in the world today. It comes through in the CEO survey as well. That CEOs are seeing an opportunity in China, but they're going to do it differently. No, we actually still see China as an investable opportunity, but we are seeing management teams that are already there or wanting to be there doing it in different ways. India continues to be a bright spot in the world that we see today. When you look at the combination of mid-tier growth rates from a GDP perspective and the stability of the country itself in terms of what's happening. Let's remind ourselves between the talent that India has as well as the manufacturing capabilities and being an alternative from a supplier of goods and services around the world, big opportunity. So India is seen as very positive right now. And I think personally, there's going to be a lot more upside potential for India to capitalize, both in terms of how it serves the domestic economy, but also to be a supplier to the world as organizations redesign supply chain. Is you're going to start to see some bankruptcies. Those organizations that were able to ride the curve, so to speak, and ride that wave, higher interest rates means they're not going to have access to free money, for lack of a better word. So we'll see bankruptcies. We'll see restructuring of debt quite a bit. And we'll see some organizations sell off businesses to create some value to pay that debt down. We'll see other organizations take some risk and actually say, hey, there's an opportunity to maybe out-execute my competition.
Moving on, the Reserve Bank of India has issued a discussion paper proposing stricter rules on provisioning for loans. The paper proposes that banks must start providing loans when they sense the first sign of trouble and not after the loans have turned into non-performing assets. Ritu Singh joins us now with the details. Ritu, what does this essentially mean for banks?
Well, there's a new approach for provisioning by banks, which is in the works, that is going to align Indian banks with global standards. Now, NBFCs have already moved to this expected loss model, and now RBI has floated a discussion paper on the same for banks. Now, currently, if you see, banks follow an incurred loss model where they make provisions only once repayments are delayed or not paid. But now, RBI has proposed that banks start providing as soon as they expect any kind of loss. Now, under this approach, banks have to classify loans in 3 categories. Stage 1 will mostly be all your standard assets. Stage 2 will be loans which are seeing some potential stress, and Stage 3 will broadly be loans that are in default. Now, banks can design and implement their own models to assess how much they need to provide in each of these 3 stages, but there will be a minimum provision requirement set by the RBI. These models will also have to be independently verified, and banks will have to make disclosures on the methodology as well. Now, in terms of the transition to this, firstly, comments are invited on this discussion paper by the end of Feb, after which RBI will come out with final guidelines. But the impact is not going to be immediate because banks will get at least 1 year for implementation, and a maximum period of 5 years is proposed to phase out the higher provisioning and avoid any capital shocks to banks. Now, in RBI's own words, it expects the potential initial impact of this application on banks' capital to be very significant, and broadly the sense is that provisions will rise. Now, CLSA, for instance, expects a limited impact on private banks, but for public sector banks, it says there's a need to build capital buffers. Macquarie believes provisions could be much higher because the probability of default has been high in the past 5 to 10 years, and the impact will be starting to be felt from FY26 onwards. Morgan Stanley believes that the potential impact is going to be manageable, with larger private banks better placed than the others to weather this, and Jefferies also holds a very similar view.
Right, thank you, Ritu, for that. Now, Reserve Bank of India has said that the likely reversion to old pension scheme remains a major risk for states. In its latest report on state finances, RBI has also said that reversal to old pension scheme will postpone current expenses of states to future accumulation unfunded pension liabilities in coming years. This after states like Chhattisgarh, Rajasthan and Punjab recently reverted to the old pension scheme. Swedish defense manufacturer Saab has reportedly scrapped its agreement with the Adani Group to build Gripen fighter jets in India. Saab's chairman told Business Standard that the company will no longer pursue the arrangement, which was announced in 2017. He said that Saab will opt to manufacture fighter jets in a company where it owns 74% stake. And it's time for a short break. Stay tuned. We'll be back with more news and updates.
Welcome back. You're watching our continuing coverage here at Davos 2023. Joining me now is Geeta Gopinath. Geeta, thanks very much for joining me. Does the year look any better at this point in time in terms of the indications that you're picking up? I've heard many CEOs talk about no recession. Some talk about a mild recession. Some saying that it's possibly just going to be slower growth for the next 12 months.
Hi, Shireen. Always a pleasure to join you. If I were to describe our outlook for 2023 in one line, it would be that we see a tough year ahead, but with signs of resilience.
Okay.
So we have a tough year because we still have the war and its consequences. We have inflation that has been coming down, but still is high. And we have climate shocks and COVID shocks still around the world. But the resilience is coming from strong job markets in many countries, consumption holding up. And so the way we see it is we have global growth projected to bottom out this year. So the second half of this year, it starts improving and then rebounds in 2024. So, we have some positive things to look forward to in the second half of this year and going forward.
Speaking of the positives, and you said consumption is holding, the labor market continues to be resilient at this point in time. What could possibly turn that around? I mean, we are now living in an era of high interest rates and high inflation, something that corporations are not used to, the global economy is not used to. What do you see as being the long-term implications, the fallouts of this new environment?
So what we will see, but we haven't seen so far, like you said, is softness in the labor market. Now, we've had substantial monetary policy tightening. One of the reasons we expect global growth to decline this year is because we will see the effects of those tight monetary policy that usually plays out with a lag. So we will likely see it in labor markets. We will see unemployment rates going up. Now, the question is, how much will it have to go up by? The view is that if there is weakness, it will be not substantial, but we'll wait and see about that. I think another factor that's affecting the outlook is China, because China has moved pretty strongly away from its zero COVID policy. So we're going to have a couple of months where conditions will be tough in China, but then we expect to see a rebound in China too.
Do you believe that this rebound is likely to be sustainable as far as China is concerned? Because they do have significant problems.
So China does have other issues. When you look at the property sector, for instance, we see a crisis there. But that said, you looked at the most recent numbers that came out for China in terms of its growth for 22, which was around 3%, very low. Relative to that, we certainly will have a rebound this year.
Let's talk about India as well, because that continues to be spoken of as the bright spot, an economy that's been fairly resilient over the past 12 months or so. What's the expectation now, not just in terms of growth, but also the opportunities that India can leverage on in the context of this reshaping that we are seeing at this point in time?
So India is doing relatively well when you compare it to other economies in the world. In terms of our growth numbers, we have 6.8% for this fiscal and 6.1% for next. But again, looking ahead, I see a lot of businesses, a lot of companies who are looking to India as an investment destination as they try to diversify away from other countries, including China. So this is a good time for India in terms of being able to draw more of the global supply chain towards India. India also has the G20 presidency, so there is, it is very much on the world stage.
It is on the world stage. But in terms of what it would in fact take to get more manufacturing FDI into India, as we see these shifts that are taking place, and some of these shifts could perhaps be structural in nature. I'll get to that in just a second. What more do you believe would need to be done, if anything at all, on the policy front?
So on the plus side, there's been a lot of progress on the physical infrastructure, a lot of progress on the digital public infrastructure, and I think both of those are making India more attractive as a destination at this point. In terms of issues that still need to be addressed, I would say labor markets, more labor force participation, certainly from women, reducing the youth unemployment rate, just getting labor markets to be somewhat more flexible, more resilient would be very helpful. We still need land reforms in India. That's another area. But a lot of action has been taken. Like I said, there's a lot of positive sentiment towards India.
Let's talk about the big threat that you warned the world of here just at the start of Davos, and that is greater fragmentation. And the theme here in Davos is to foster and nurture greater collaboration so that we don't go down that path. How real do you believe that threat is in the short term, and what is its impact going to be?
I mean, I think it's very important for, events like Davos, where it brings together the public sector, the private sector, to help prevent such a fragmentation from happening. That said, I think the pandemic and the war has made all countries much more concerned about economic security and national security, and that's causing them to undertake policies that, could lead to greater fragmentation around the world. There are very serious costs if this becomes runaway fragmentation and we have decoupling around the world into different economic blocks. I mean, the cost in terms of world GDP could be around loss of 7% of GDP, which is basically like losing the economies of Germany and Japan on a permanent basis, because that is very costly. And it's something that we are, advising countries just to be very careful about, that when they put policies in place, that they recognize that this can have very big spillovers to the rest of the world.
But do they recognize the impact that you just spoke of? Or at this point in time, given how fractured the world is and the lack of dialogue between large blocs, is this threat imminent?
I think people do recognize that there is a serious risk. A good sign was last November at the G20 Leaders Summit, when President Biden and President Xi Jinping met after a very long time. The whole point of that meeting was to put a floor on their relationship, because it's so important for the two largest economies of the world to work together. So I do think they're aware of it, but I still worry that policies will not necessarily move in the right direction. So we are worried about that.
Geeta, let me end by asking, you said 2023 is going to be a tough year. How tough of a year is it going to be for central banks? We were just talking about how, in a way, central banks now have front and center the one objective that they have to deal with, which is inflation management, and not take on any further obligations. How tough is the year going to be for central banks?
I think it's going to be a tough year because they're going to have to make the decision about how long to keep monetary policy restricted. As you can see, markets are very eager to escape the tight monetary policy environment, and based on their expectations, inflation will come down very quickly and interest rates they will start cutting interest rates. I think it's premature to make that conclusion, and monetary policy will have to keep fighting that narrative.
And it's going to be a while before we see that stopping, you think?
I mean, again, we have to see what the inflation data brings in. But as of now, I think they would have to keep, the US, for instance, would have to keep interest rates at around 5% through 2023.
Geeta Gopinath, always a pleasure. Appreciate you joining us here on CNBC-TV18. Thanks very much for your time.
Thank you.
Well, we are going to take a break, but continue our conversations here on Davos 2023. Don't go anywhere. We're back in a minute with more.